Okay, let's dive right in. JP Morgan is forecasting gold to hit $4,000 per ounce by mid-2026. I mean, that's a headline that definitely makes you sit up and take notice.
It really does, and it's exactly what we're digging into today.
Yeah, we're doing a deep dive into JP Morgan's analysis on where gold and silver prices might be headed.
And what's striking right away is, well, the confidence behind this call. It's not just a maybe. They seem pretty strongly convinced that $4,000 gold is, on the cards.
Exactly. We've got their detailed report here, and the goal today is really to pull up the key insights for you, not just the what, but really get into the how and why they're making such a, well, such a bold prediction.
Right. We want to break down the factors they see driving this and also what they're thinking about silver, too.
Because this isn't just some number plucked out of thin air, is it? It's tied into everything happening globally, finance, commodities.
Absolutely. It reflects these big forces at play. Things like tariffs, the geopolitical shifts we're seeing, what central banks are doing. JP Morgan's argument ties all these threads together to build this bullish case for gold.
Okay, so let's get into that, the big question. Why this potential surge to $4,000 gold? JP Morgan seems to point to a few interconnected things, but geopolitical and economic uncertainty seems right at the top.
That's definitely a major piece. They're highlighting risks like recession, even stagflation, partly driven by trade policies.
You mean the whole U.S.-China situation?
Yeah, that ongoing dynamic, the increased U.S. tariffs, it just adds a lot of instability to the global economy, to trade. And then you layer on top these shifting alliances, things feeling, well, unpredictable geopolitically.
So it creates this climate where investors start looking for safer places to put their money, like gold.
Exactly. Assets seen as safe havens tend to do better when things feel uncertain.
Makes sense. And it's not just investors reacting to headlines, right? Central banks themselves are a huge part of this gold demand story.
Oh, absolutely crucial. JP Morgan is forecasting, get this, 900 tons of gold buying by central banks in 2025.
900 tons. That's a massive number.
It is. And what's interesting is this ongoing trend of banks wanting to diversify their reserves, moving away somewhat from holding quite so much in U.S. dollars.
Even though the dollar share ticked up slightly at the end of last year.
Yeah, it did edge up a bit to finish 2024 at 57.8%, but the underlying drive to diversify, JP Morgan thinks that's still very much intact.
And that swift cutoff for Russia back in 2022, that must have really focused minds and central banks everywhere about, reserve risk.
That seems to be the thinking. The report suggests that even if, say, Russia and the West start re-engaging down the line, the precedent set by cutting off SWIFT access, well, that's likely to keep that diversification trend going.
So who are the big buyers we've seen recently?
Well, in 2024, the report mentions several countries adding 20 tons or more, places like Poland, Turkey, India, Azerbaijan through its state oil fund, China, Czechia, Iraq. Quite a diverse group.
And is there potential for even more central bank buying from countries that maybe have huge reserves but not much gold yet?
That's a really key point they raise. What is the right level of gold for a central bank today? There's no single answer, but JP Morgan does this interesting calculation.
Oh, yeah.
They say, look, if central banks currently holding less than 10% of their reserves in gold decided to bump that up to 10%, that alone could mean something like 4,000 tons of extra gold demand.
Wow. 4,000 tons.
Yeah. So countries with big reserves but relatively low gold allocations, they mentioned China, India, Japan, Saudi Arabia, they're definitely ones to watch.
Okay, so massive central bank demand, potential for more. What about investors? Funds, individuals, where do they fit in this $4,000 picture?
They're another big pillar of the demand story. For investors, gold is looking more and more like a necessary hedge.
A hedge against what specifically?
Well, against a few things, really. Stagflation risk, the chance of a recession, maybe currency debasement, the value of money eroding, and just general uncertainty around, say, U.S. policy.
And the odds of a U.S. recession seem to be creeping up in some forecasts, maybe prompting the Fed to cut rates sooner. Does that play in?
Definitely. That possibility makes non-yielding assets like gold relatively more attractive compared to bonds.
Plus, we've seen some wobbles in the U.S. government bond market itself recently, haven't we? Yeah. Maybe shaking that ultimate safe haven status a little.
Exactly. The report notes some unusual volatility and risk aversion even in U.S. Treasuries, which are usually seen as super stable. That kind of uncertainty tends to push some investors towards gold as an alternative store of value.
So new money potentially coming into gold.
Yeah, they see potential for new investor types entering the market. Plus, you've still got strong retail demand, particularly in China, especially if the yuan might weaken.
And isn't there something about Chinese insurance companies now being allowed to buy gold?
Yes, a pilot program. It allows them to invest up to 1% of their assets in gold. It sounds small, 1%, but given the size of the Chinese insurance market, that could potentially unlock something like $27 billion of new demand.
Okay, so institutional demand, retail demand. It feels like a lot of different players are seeing reasons to own gold. How um, how sensitive is the price to all this buying? Does the report quantify that?
It does, and this is quite insightful. They've calculated a sort of break-even point. They reckon you need about 350 tons of net demand per quarter, that's from investors and central banks combined, just to keep gold prices stable.
Right, just to tread water.
Exactly. And then for every extra 100 tons of net buying per quarter above that 350 level, they estimate it corresponds to roughly a 2% increase in the quarterly gold price.
Okay, that really puts a number on the demand impact.
It does. And they point out that since the second quarter of 2022, this net demand has actually been entering around 570 tons per quarter.
Way above that break-even level.
Way above. And that's a key reason, they argue, why gold has been so resilient, price-wise. It held up even when U.S. bond yields minus inflation were rising. Usually, higher real yields make gold less attractive because gold doesn't pay interest.
Got it. So the demand has been strong enough to overcome that headwind. Okay, so that covers a lot of the why. Let's turn to the how, the actual price path JP Morgan sees.
Right, the forecast itself. They're projecting an average price of $3,675 per ounce by the fourth quarter of 2025.
$3,675 by late next year.
And then they see it pushing past $4,000 per ounce by the second quarter of 2026.
Wow. Okay, and that's based on demand staying really strong?
Yes, they expect demand to average around 710 tons per quarter to support that trajectory.
And where's that 710 tons coming from? Can they break it down?
They do. It's a mix. Central banks are expected to keep up a strong pace, about 225 tons per quarter on average, which lines up with their 900-ton total forecast for 2025.
Okay.
Then you have investors in the futures market. They expect net long positions to push up towards maybe 900 tons this quarter, then settle a bit lower, maybe around 800 tons in the second half of 25.
And ETFs, gold-backed funds.
Big inflows expected there, too. Around 715 tons of net additions across 2025. They note that Chinese gold ETFs have been particularly strong already this year, up something like 46% year to date.
Huh. Interesting regional dynamic. What about physical bars and coins?
Still growing. They expect about 2% year-over-year growth in 2025, which translates to roughly 300 tons per quarter.
So a pretty broad-based demand picture supporting that price forecast.
Yeah.
But, forecasts can be wrong.
Yeah.
What could knock this off course? Or would they talk about bearish risks?
They do consider some, though they view them as less likely. A big one would be if central bank buying suddenly dropped off significantly, or if some major central banks actually started selling large amounts. That would definitely hurt prices.
Okay, what else?
Another risk factor could be a sudden wave of successful trade deals, especially if the U.S. and China reach some kind of major agreement. That might calm recession fears and reduce the need for safe havens.
Right, less uncertainty.
And finally, if the U.S. economy turned out to be surprisingly strong and resilient, allowing the Fed to really focus on fighting inflation aggressively, maybe hiking rates more, that could also potentially draw money away from gold. But again, they see these as the less probable outcomes right now.
Got it. Okay, let's shift gears slightly and talk about silver. Its story seems a bit different, at least in the near term.
That's right. Silver's facing some, let's call them headwinds, mostly related to industrial demand uncertainty.
Because silver is used much more in industry than gold is.
Exactly. So its price is more sensitive to things like overall economic growth, how much industrial activity is happening, and specifically things like demand for solar panels, particularly in China, which uses a lot of silver.
So some near-term question marks, but longer term.
Longer term, they still see the silver market being in a supply deficit, meaning demand outstrips supply both 2025 and 2026.
So the fundamentals are still tight, even with the industrial demand wobbles.
That seems to be the view. They expect a sort of catch-up window for silver, likely starting in the second half of 2025, as the picture for industrial metals perhaps becomes clearer or stabilizes.
And what does that mean for the silver price forecast?
They're forecasting an average price of around $35 an ounce for 2025. But they see it rising through the year, maybe hitting around $39 by the end of 2025.
Okay. And further out.
For 2026, they're projecting an average of around $43 an ounce.
Right. And that gold to silver ratio, the price of gold divided by the price of silver, that's gotten quite high recently, hasn't it? Over 100?
It has, yeah. Historically, when that ratio gets really high, some people see it as a sign that silver might be, relatively undervalued compared to gold and could be due for a catch-up.
Interesting. Okay, just finally, let's quickly touch on gold's traditional roles. It's often talked about as an inflation hedge and a store of value. How does that fit into the current picture?
Well, it's very relevant. Historically, gold has often been a decent hedge against inflation, especially when inflation picks up quickly and stays high. It doesn't always outperform everything else. Sometimes other commodities do better, but it generally holds its purchasing power pretty well over time during inflationary periods.
And as a hedge against economic trouble.
Yeah, it tends to behave differently from stocks, especially during big market sell-offs. It often rallies after U.S. recessions have begun, so it provides that diversification benefit.
And the store of value argument against currencies losing value.
That's the long-term case. Gold prices have, over the very long run, tended to keep pace with things like the expansion of the money supply or government debt, and it certainly outperformed most major paper currencies quite significantly since, say, the early 2000s.
Okay, so wrapping this all up, the main message from JP Morgan seems pretty clear.
Yeah, the core takeaway is their strong conviction in a structural bull market for gold. They see this confluence of factors: the geopolitical risks, the massive central bank demand driven by diversification needs, and solid investor demand looking for safety, all pointing towards significantly higher prices.
With silver maybe playing catch up a bit later on.
Exactly. Silver's expected to participate more fully later this year and into next.
And for you, listening in, hopefully understanding these big global forces, the trade issues, the potential for recession, what central banks are up to, gives you some valuable context for just making sense of the current financial world. It's definitely a unique environment for precious metals right now.
It really is. And it leaves us with a final thought, maybe for you to mull over. Given everything we've discussed, gold's history in uncertain times, the potential for more instability, what level of gold, if any, makes sense for you in a well-diversified portfolio over the next few years? This report certainly makes the case that the forces pushing gold demand aren't going away anytime soon.